So again today we all are here to learn something in financial services classes. Okay, last class mutual fund topic got over as per syllabus. So today we'll start the new topic naming venture capital. Fine. So venture capital, I believe in your fourth sem in IFS subject also you have studied. So maybe little bit it will be a repeat telecast for you. Just a diagram that venture capital involve what and all things, like it involves risk capital and it is raising of money and it is for business or mainly for the startup or such type of startups who is having a growth, and it is in a method of equity where we have the return and it is kind of private fund. So just a mixer in a diagram. Okay, so first we'll check out the meaning of venture capital. Okay, so venture capital, also called as VC, shortcut I love, you know very well. Okay, but only while learning shortcut, not writing in the exams. Okay, now VC, it refers to the financing of startup companies. Okay, financing of startup companies or small companies. Okay, which is having definitely risk level little bit higher, but same time having a high wealth chance of getting good returns. Okay, or having a huge potentiality to grow in near future or in the long run. Okay, so here because of as it is having a little bit high risk. Okay, so we used to call it also as a risk capital, which include risk of losing the money if the venture does not succeed. Okay, and it is for the longer period, or you can say it takes medium to long term for the investment. Okay, return on investment you will get in the medium to long term. So this is your venture capital. Capital, money investment in your small and startup companies, which involve high risk but same time having the potential for high growth in near future. Okay, now we will check out the features of venture capital. First feature is your high risk. Fine. So venture capital, as just now I told you in the meaning also, venture capital we used to refer it as a risk capital also. Fine. So it's a highly risky project, but definitely the objective used to be the earning a high rate of return. Risk factor high because there is a inherent risk of losing the invested capital if business does not succeed. Okay, so risk level is always high in your venture capital investment. Next we have lack of liquidity. Okay, and then third we will go not third, then we will go for the last one, long-term horizon. Your lack of liquidity and long-term horizon is somewhere interlinked. So I will explain together. Okay, lack of liquidity means whoever is going to invest. Okay, and one more thing, just keep remember. Okay, whoever used to invest in any company in terms of venture capital. Okay, we used to call those investors as a venture capitalist. Okay, so for venture capitalist, the investment return on investment quickly not possible, because in the meaning also we have seen that it is for the medium to long run. So whenever you want the return on your venture capital investment, you have to wait for some long duration, and because of that you will not have the liquidity quickly. Okay, and when we say long term horizon, that means long term time. Okay, venture capital finance is actually long term investment. Fine, and investors do not expect the immediate return on their investment. Fine, you have to manage the funds effectively, efficiently, which will give you the better returns in near future, but it will take a little bit longer time. Longer time when we say maybe 3 years, 5 years, 10 years, 15 years. Okay, depend upon the nature of business or depend upon the future of the business. Okay, then coming back to your third feature, equity participation and capital gain. So venture capital finance. Okay, there are various methods for venture capital investment, where one is very famous, that is equity participation. That means the investor is going to buy the equity. Further also we will check today only what are the different methods. Okay, just in feature I'm going, where the investors are going to invest in the business, startup business, in terms of equity participation. That means they are going to buy the equity shares of that company. Objective is what? Objective is to make the capital gain. How? By selling the shares once the firm become profitable. So in near future, when the firm will become profitable, they will sell the equity shares in the open market, or maybe back to the company only, and they will have the capital gain. So that is one feature. Another we have next, that is venture capital investments are made in a innovative project. So that is a, you can say, a kind of limitation also, or you can say it is as a boundary also, or speciality also. Okay, because venture capital investment is not available for all type of business. Okay, it is available for small business, startup business, and whoever is having innovative ideas. Mainly they are here for promoting the innovators. Okay, so we used to say that venture capital investments are made in innovative projects. Next we have supplier of venture capital participate in the management of the company. So whenever you are going to provide the investment in terms of venture capital, okay, or you are going for a equity participation, or you are going to follow the some other methods, specifically the equity participation will give you the voting right, okay, and you will have the full right to get involved in the management of that company. Because venture capital, risky investment, so venture capitalists take active interest in management of the assisted firm. Okay. Then long-term horizon, just now we have checked. So next we'll go for the methods of venture capital financing. First method, as in feature also we have checked. Okay. First method is your equity financing. So investors are going to purchase the equity shares of that small company or small business, okay, or whoever has initiated or whoever wants the venture capital finance. Okay, investors are going to buy their equity shares, but make sure the investor's contribution is not more than 49% of total stake. Reason is what? The entrepreneur should have the ultimate powers, okay, as a main operator of the business or as the owner of the business. When we can go for equity financing? When a company requires money to finance the startup, okay, and huge capital requirements are there, fine, but same time having the potential to grow in high profitable ventures, so company can go for the equity financing. Company offer a percentage of business to the investors in exchange for capital, okay, an investor who buy the shares get the voting rights, fine. So, and always keep remember, the investor's contribution should not more than 49% of the total stake. This is your equity finance, mainly for the capital gain. Okay. Next method is your participating debentures. Okay. So startup companies can raise the funds by issuing debentures also, where they have to give the guarantee to repay the amount of the invested money when the security will get matured. Okay. A company has to pay the interest on the money invested at the fixed maturity date. And interest payable on the debenture, 3 various rate is there according to the phases of the business. That is before the commencement of operation, you don't have to pay if you are the company who has availed the venture capital through the debenture method. So before the commencement of operation, no interest is going to be paid by you. Okay, and once the operation commences in the market, low rate of interest you have to pay, and when you will reach to a particular level of sales and profit, you have to pay the high rate of interest. That is in method of your debenture. Then next we have conditional loan, next method. Okay, conditional loan, what happened? The entrepreneur need to pay the lenders in the form of royalty. Okay, royalty chapter, too much you have invested your time in your first semester financing accounting. Okay, so here in conditional loan also entrepreneur has to pay the pay royalty to the lender, okay, and no interest is payable to the lender for the loan amount, and royalty rate will vary between 2% to 15%, okay, and that will be based on the revenue or profit percentage or cash flow of the venture. That is your next is our next method of venture capital financing is income note, okay. It will have the combined characteristics of traditional loan and conditional loan, and in this case entrepreneurs need to repay the principal amount along with the interest within the predetermined specified period or agreed period, and same time entrepreneurs need to pay a royalty on sales or profit. So that is your income note. Then next we have convertible loans. So it comes, or you can say it is a part of debenture financing, venture capital one, okay. So in case of debenture we have seen that your startup companies raise fund by issuing debentures with a guarantee to repay the amount invested money when the security will mature, that is specified duration, okay. But if in any case if they are not able to repay the principal amount, invested amount with the interest in that within that specified fixed maturity date, then those debentures will get converted into equity shares, okay. And then we have the last one, conventional loan. So under conventional loan, entrepreneur has to pay low rate of interest at the initial stage, and as the profit will increase, the interest rate will also increase, okay. So and sometimes it will happen that along with the interest on borrowed capital, the entrepreneur need to pay a royalty in accordance with the sales or profit. So that is your conventional loan. So for the day this much, okay. Next class we'll check out the next thing. Thank you. Have a nice day.